We are again watching that historic crash in crude oil prices. The May futures contract yesterday dove into negative territory, meaning that you had to pay somebody to take oil from you. That's the first time that has ever happened in history. It didn't even happen during the Great Depression. It didn't happen during the Civil War. And there are major concerns about the outlook for the commodity. Right now, let's bring in CNBC's very own Brian Sullivan, also John Kilduff, who is with Again Capital and a CNBC contributor. Brian, why don't we just start with you? You cover the oil markets. Again, we've never seen anything like this, but what happened yesterday?
I guess the best way I can say it, Becky, is you buy something on Amazon.com for $30. The guy shows up at your door to deliver it. You pay him $50 to take it back. I mean, it's not a perfect analogy, but that's basically what happened. Now, we got to remember, it's a very small number of contracts that had negative pricing. That May contract was trading for a long time. But the reality is, if there's no place to put the oil and the oil contract requires you to take physical delivery, you're going to pay whatever it takes to get out of that contract. As I said yesterday on the air, there might be other aspects to it. We could have seen some funds getting deep doo-doo, if you know what I mean. Could be an ETF impact, some of these leveraged 2 and 3 times ETF. We still don't know, but what an historic day.
Hey, John, we know this happened because worldwide oil demand shut down as countries kind of shut down because of coronavirus. I think world demand dropped somewhere from 25 to 30%. We have heard from the OPEC Plus nations saying that they're going to cut barrels per day by about 10% of global oil supply. We have now heard that American producers like Exxon and Chevron are kind of cutting back their production. We heard it from Canada with the tar sands yesterday. When does the situation stretch out or kind of meet ends where the actual continued production actually meets up with lower demand that we see? Or does demand pick up first? What do you think happens?
Well, I can tell you here in the U.S., the cutbacks are real and significant. I mean, you could argue that the U.S. has already cut 700,000 barrels of production. We were at 13.1 a few weeks ago. We're at 12.4 as of last week's report. We'll see where we are tomorrow when the Department of Energy issues its weekly report then. I would expect a further decline. The U.S. rig count, Becky, is down over 50% just since July. And it's been a meteoric fall in terms of that setup. So the OPEC Plus cut, there seems to be a complete lack of enthusiasm among the folks who got involved with that to actually cut. The Saudis are waiting till May 1st. Russia actually raised their production last week by about 1%. So I don't know what they're doing. And on top of that, I know Sully was talking during his show about this flotilla of crude oil that's coming our way, courtesy of Saudi Arabia, who I guess is just trying to put the final dagger in the heart of our guys in the Permian. That's all I can think of. So I think it's going to take a while for the demand to come back, unfortunately, and you just can't cut enough in this environment to offset that loss.
Yeah, Brian, I saw you talking about the tankers that were on their way here, too. And maybe you can explain to us, if we've got so much crude oil here, how come we are still accepting crude oil from other places? Is it just the refineries that need specific types of crude?
There's that. There's contracts. Also remember that Saudi Arabia owns the majority of the Motiva refinery in Texas. It's their refinery for the most part. It's the biggest refinery in the United States. So it's basically shipping crude oil to their refinery. You've also got a situation where it could be even less expensive to take delivery on the Gulf Coast where you need it rather than trying to get it from, say, Oklahoma down to Houston, which would normally be easy. But if the pipelines are full and if they're jammed up, they're not running, there's no place to store it while you wait to refine it, you have to take it by sea. It's not just a question of the fungible commodity. It's a question of where exactly that is. And by the way, if our viewers missed that segment, we did it at about 5:30. Hopefully it'll be on the web soon. There is, according to marine traffic and tanker traffic, 50 million barrels of oil coming from Saudi Arabia right now. Most of it is around Africa, sort of maybe a couple of weeks out. Think about that, guys. The Strategic Petroleum Reserve, we talk about using that to fill up oil. That's 75 million barrels of available space. In other words, this armada of oil, as I called it, that's currently on its way here is more than half of the SPR. That's not what we're going to use it for. I'm just trying to put it in context.
Wow. Yeah.
It's
hey, John,
unbelievable.
the president did bring up this idea. Did bring up this idea yesterday.
I'm sorry, Becky?
The president did bring up this idea yesterday of using this time to fill up the strategic petroleum reserve. Seems like a good idea if they're basically paying you to take it at this point.
Oh, we absolutely should be. We should fill it to the brim. We should look for other places. We should do. China is doing this very thing right now. It's the strategic thing to do. Buy super low and keep it for when we need it. Because my fear continues to be that as our U.S. producers have to retrench because of the commercial aspect and situation that they operate in, we could be behind the 8 ball before you know it in maybe a year or so's time, where the Saudis have the upper hand, and they won't be sending us 50 million barrels. They'll be withholding it to get the price high again. So, and just when consumers won't be able to handle it and have a higher pump price. So, it's a dangerous game that the Saudis are playing with us right now, if you ask me.
Yeah, and we just have to stop taking it out of the ground, Becky. I mean, the bottom. I don't want to see anybody lose their jobs, but here's the. I mean, it's what time is it? 6:25. The stupidity of what's going on right now, and I'm sorry to be so harsh about it. We're paying to take it out of the ground. Now we're paying people to take it from us, and then we're paying to put it back in the ground. We're paying 3 times for the same barrel of oil to take it out, move it around, and then put it back in the ground somewhere. I mean, I'm being a little bit hyperbole, but you get the point. It's just dumb. We need to stop the production so the industry can survive.
John, to that point, the idea that some of these companies are not going to be able to survive this, we've talked for many years at this point about how it was really easy to turn back on production every time prices went up and shut it off every time they went down. Have we reached the lower limits of that, where this time it's so bad that if you shut it off, you're not going to be able to turn it back on because the companies underlying that went out of business? I'm not talking about the big companies that have lots of different diversification lines, other things that they can do, lots of cash and lots of access to the public
Becky,
markets.
after the 1998
how big of a problem
price debacle or oil bust, there was a lost decade for the U.S. oil producers. It's what got us in hot water and triple-digit oil in the 2010s and for many years after that. So what's going to happen here is that these independents will go out of business, and the big companies will pick them up, and we're going to have a lot more production discipline. So maybe that'll be better and more stable for the industry. But as far as the wildcatters and a lot of the aggressive producers, those days are over.